In the dead of the Cold War, a paradox sits in the ledgers of American banks. The Soviet Union, an empire sworn to the destruction of global capitalism, is quietly hoarding United States dollars. They sell oil, timber, and gold to the West, and in return, they receive the only currency that matters in the post-war world. But this wealth comes with a fatal vulnerability. To spend those dollars in international markets, the money must physically or electronically reside in accounts held by New York banks. Institutions like Chase Manhattan and Citibank hold the Soviet wealth. In Washington, the Treasury Department and the Federal Reserve possess the ultimate weapon, the freeze. With a single administrative order, the United States government can sever the Soviet Union from its own money. It has happened before to enemies of the state. The realization terrifies the financial bureaucrats in Moscow. They need the capitalist currency to survive, but they cannot leave it in capitalist vaults. Their solution is a bureaucratic maneuver, a quiet transfer of digits from New York to a handful of obscure Soviet-owned financial outposts in Western Europe.
It is meant to be a simple defensive measure, a way to hide their cash from American regulators while keeping it in dollars. But money is a living thing. By moving their dollars outside the legal borders of the United States, the Soviet Union inadvertently creates a monster. They strip the US dollar of its regulatory leash. They punch a hole in the architecture of sovereign finance. What begins as a paranoid attempt to protect a few $100 million mutates into a shadow banking system that will eventually hold tens of trillions. It is a financial dimension completely beyond the control of the Federal Reserve, a borderless realm of unregulated capital that will come to define the modern global economy. This is the story of how a communist state, terrified of American power, accidentally engineered the ultimate machinery of unregulated hyper-capitalism.
To understand the sheer scale of the accident, you have to look at the rigid borders of money in the 1950s. The world operates under the Bretton Woods system. The United States dollar is pegged to gold, and every other major currency is pegged to the dollar. If a nation wants to buy airplanes, wheat, or industrial machinery, it needs dollars. The Soviet Union is no exception. Despite the ideological Iron Curtain, the practical realities of international trade demand American currency. Soviet state-owned enterprises export raw materials to Europe and the Americas. The payments flow back in dollars. By the rules of the time, a dollar is a domestic American instrument. If a French company pays a Soviet enterprise $1 million, that transaction ultimately settles on the books of a bank in New York. The money never truly leaves the United States. Only the ownership of the account changes hands. For the financial architects in Moscow, this is a ticking time bomb. The early years of the Cold War are defined by sudden, sweeping acts of economic warfare.
In 1950, during the outbreak of the Korean War, the United States government froze the dollar assets of the Chinese and North Korean governments. Millions of dollars were trapped overnight, rendered entirely useless by a single signature in Washington. As tensions rise over divided Berlin and the looming threat of nuclear escalation, Soviet bankers realize their entire reserve of foreign exchange is sitting in the crosshairs. If they provoke Washington, their accounts at Chase Manhattan could be frozen instantly, paralyzing the Soviet Union's ability to trade with the outside world. They face a seemingly impossible dilemma. They cannot convert the dollars into gold and ship it to Moscow because moving physical gold is slow, expensive, and useless for rapid daily international trade. They cannot convert the dollars into British pounds or French francs because those currencies are strictly controlled by their own governments and are not universally accepted for global commodities. They must hold dollars, but they must not hold them in America. The blind spot of the mid-century financial system is the assumption that a currency must live within its sovereign borders.
Regulators at the Federal Reserve believe that because they control the creation of the dollar, they control its existence everywhere. They mandate how much interest American banks can pay on dollar deposits. They mandate how much capital banks must hold in reserve. They view the dollar as a domestic utility. But the Soviet bureaucrats see a loophole. They realize that a bank deposit is not a physical stack of green paper in a vault. It is merely a promise, a legal liability.
If they can find a bank outside the United States willing to hold a dollar-denominated liability, they can maintain their purchasing power without submitting to American jurisdiction. They need a bank that is legally European, operating under European law, but fully owned and controlled by the Soviet state. They need a financial safe house, and they already have two. In London, they have the Moscow Narodny Bank. In Paris, they have the Banque Commerciale pour l'Europe du Nord. These institutions were established decades earlier to facilitate trade, operating quietly on capitalist soil. Now, they are about to become the vessels for the greatest financial prison break in history.
The bureaucrats in Moscow send the order. The dollars must be evacuated. The ledgers in New York are about to be rewritten, and the global economy will never be the same. The execution falls to a small cadre of Soviet bankers operating deep inside capitalist financial centers. These men are loyal members of the Communist Party, yet they wear bespoke suits, operate out of prestigious addresses, and understand the mechanics of Western banking better than many of their capitalist peers. At the Banque Commerciale pour l'Europe du Nord in Paris, the strategy takes shape. The bank is incorporated under French law, making it immune to direct orders from the United States Treasury. Yet its sole shareholder is the Soviet state. The executives in Paris instruct their correspondent banks in New York to transfer the ownership of Soviet dollar deposits. The money is legally moved from accounts held directly by the Soviet government to the correspondent accounts held by the Paris bank. From the perspective of the Federal Reserve, the dollars are still sitting in New York. But legally, those dollars now belong to a French bank, and that French bank owes a dollar-denominated debt to Moscow. The American regulators cannot freeze the assets of a French bank without triggering a massive diplomatic incident with an allied European nation. The shield is established. The Banque Commerciale for the Europe to North has a telex address used for international wire communications. The address is Eurobank. When traders and financial institutions begin to refer to these specific dollar deposits held in Paris, they call them Eurobank dollars. Soon, the term shortens. They become known simply as Eurodollars. It is a profound mutation. A Eurodollar is exactly the same as a regular US dollar, except for one critical difference. It exists entirely outside the regulatory apparatus of the United States government. Across the English Channel, the Moscow Narodny Bank executes the same maneuver. Millions of Soviet dollars flood into London, resting on the balance sheets of an institution overseen by the Bank of England, not the Federal Reserve. The British regulators notice this strange accumulation of foreign currency. The Bank of England faces a choice. They could crack down on this unnatural holding of American currency on British soil. But Britain is nursing a fragile post-war economy. The pound sterling is weak. The City of London is desperate to rebuild its status as the center of global finance. When British regulators look at the growing pile of Soviet Eurodollars, they do not see a threat. They see capital. They see a new market. The Bank of England quietly decides to let the Soviet banks operate this offshore dollar network without interference. They choose not to impose reserve requirements on these foreign currency deposits. This quiet regulatory forbearance is the spark. By looking the other way, the British authorities guarantee that London will become the home of this new invisible currency. The Soviet bankers have successfully hidden their money. They have outmaneuvered the American Treasury. But they have also created a financial instrument that obeys no central bank. They have minted a stateless currency, and the most aggressive capitalist institutions in the world are about to discover its power. The dam breaks when Western bankers realize what the Soviet Union has accidentally invented. A dollar held outside the United States is a dollar free from American rules. In the 1950s and 1960s, the Federal Reserve enforces a strict regulation known as Regulation Q. This rule caps the amount of interest American banks can pay on domestic deposits. It is designed to keep the banking system stable and prevent reckless competition. But Regulation Q does not apply to London. It does not apply to Paris. It does not apply to the Moscow Narodny Bank or the Eurobank. Suddenly, British and European banks realize they can offer higher interest rates on dollar deposits than any bank in New York.
If an American corporation has $1 million in spare cash, they can leave it in Manhattan and earn a meager regulated return. Or they can wire it to London, convert it into a Eurodollar deposit, and earn a significantly higher yield. The math is undeniable. A massive migration of capital begins. Corporate treasurers, wealthy individuals, and international merchants begin sweeping their cash across the Atlantic.
The Eurodollar market ceases to be a Soviet hiding place and transforms into a capitalist gold rush. But the true explosive power of the Eurodollar lies in lending. Because the Bank of England and other European regulators do not require banks to hold reserves against foreign currency deposits, every Eurodollar deposited in London can be lent out almost in its entirety. An American bank must keep a percentage of its deposits locked in a vault at the Federal Reserve. A London bank holding Eurodollars operates with no such friction. They lend the dollars to an Italian shipping company, which pays a German manufacturer, who deposits the dollars back into a Swiss bank. The money multiplies through the magic of fractional reserve banking, but it does so in a regulatory vacuum. Millions turn into billions. The Federal Reserve watches in mounting horror. The Central Bank of the United States realizes it is losing control of its own currency supply. They attempt to track the size of the Eurodollar market, but the data is obscured by foreign banking secrecy. They try to tighten domestic monetary policy to curb inflation, but American corporations simply bypass the domestic credit squeeze by borrowing Eurodollars from London. The offshore market becomes a massive, invisible pressure valve that neutralizes the Federal Reserve's power. By the 1970s, the system undergoes another massive shock. The OPEC nations quadruple the price of oil. The world must pay for this oil in dollars. Countries like Saudi Arabia and Iran suddenly find themselves drowning in billions of American dollars. Like the Soviets before them, they do not want to deposit this massive wealth in New York, where it could be subject to taxation, regulation, or political seizure. They funnel their petrodollars directly into the Eurodollar market in London. The offshore shadow banking system swells to an unimaginable scale. It becomes the primary funding mechanism for global trade. Wall Street banks, refusing to be left behind, open branches in London and the Cayman Islands specifically to operate in the unregulated Eurodollar space. They take domestic American deposits, wire them to their offshore branches overnight to escape reserve requirements, and bring them back in the morning. The boundary between the sovereign dollar and the shadow dollar dissolves. Trillions of dollars are created by ledger entries in jurisdictions that the United States government cannot touch. The Soviet bureaucrats who initiated the first transfers in the 1950s wanted nothing more than a safe deposit box. Instead, they provided the blueprint for a financial machine that would supercharge globalization. They proved that money does not need a nation. It only needs a ledger and a network of banks willing to recognize it. The Eurodollar market funds the expansion of multinational corporations. It finances sovereign debt for developing nations. It creates a vast pool of liquidity that fuels the rapid acceleration of the late 20th century economy. But it also introduces a terrifying new fragility. Because there is no central bank for the Eurodollar market, there is no lender of last resort.
If a panic strikes the offshore market, if European banks suddenly refuse to lend dollars to one another, the Federal Reserve has no legal obligation to intervene. The engine of global commerce operates entirely without a safety net, hovering in a legal twilight zone born of Cold War paranoia.
Today, the Eurodollar market is the dark matter of the global financial system. It is everywhere, exerting massive gravitational pull on interest rates, currency values, and economic growth, yet it remains largely invisible to the public. Estimates place the size of the offshore dollar market in the tens of trillions. It is a sprawling architecture of nowhere, a network of liabilities and promises existing on server racks in financial centers that operate beyond the reach of any single government. The ultimate irony of this system is its origin. The Soviet Union, an empire that spent decades attempting to prove the superiority of the state over the market, inadvertently built the ultimate free market mechanism. In their desperate attempt to shield their assets from the geopolitical weapon of the American government, they proved that capital could permanently decouple from the nation-state.
They showed that if you apply enough pressure to money, it will simply change its state of matter, evaporating from a highly regulated domestic environment and condensing in an unregulated offshore realm. The consequences of this mutation define our current era.
When the global financial crisis struck in 2008, the true epicenter of the panic was not just the American housing market, it was the freezing of the Eurodollar system. Foreign banks, heavily reliant on offshore dollar funding, suddenly found themselves unable to roll over their debts. The entire global supply chain threatened to halt. The Federal Reserve, despite having no legal mandate over the offshore market, was forced to step in. They opened massive swap lines with foreign central banks, pumping trillions of dollars into the international system to prevent the Eurodollar market from collapsing. The American central bank was forced to bail out a shadow system it neither created nor controlled, simply because the sovereign dollar and the offshore dollar had become inextricably linked. The Soviet maneuver of the 1950s succeeded in its immediate goal. It protected their reserves. But the legacy of the Eurobank telex is a world where the majority of United States dollars are created, traded, and destroyed outside the United States.
It is a world where national governments constantly struggle to regulate financial entities that can shift their capital across borders at the speed of light. The architecture of the Eurodollar proves that the strongest force in global finance is not the decree of a central bank, but the relentless, fluid desire of capital to seek the path of least resistance. As the world moves toward new forms of digital currency and decentralized ledgers, the history of the Eurodollar serves as a profound warning about the limits of sovereign power. When a nation attempts to lock its money in a cage, the money simply learns to build a new dimension. And so the question remains, if the currency that powers the globe exists entirely outside the control of the nation that prints it, who actually holds the power in the modern world?